Welcome to this definitive 12-minute investigative report. Over the next few minutes, we are going to peel back the layers of the most sudden and significant Bitcoin collapse in recent history. This isn't just another market dip, it's a systemic shift that will define the rest of 2026. Stay with me as we uncover the truth. It was a weekend that crypto investors won't soon forget. In less than 48 hours, over $100 billion in market value vanished. Bitcoin plummeted from its $100,000 peak down to the mid-70s, triggering a wave of liquidations that swept across the entire digital asset ecosystem, leaving even the most seasoned traders in shock. The spark that lit this fuse came from geopolitical unrest. Reports of a massive explosion at Iran's Bandar Abbas port sent shockwaves through global markets. As tensions reached a boiling point, the world's risk appetite evaporated instantly. Bitcoin, the digital gold, was put to the ultimate safe haven test, and the initial reaction was one of pure flight. Compounding the geopolitical fear were new threats of trade tariffs from the Trump administration. The uncertainty surrounding global trade policy created a perfect storm for market instability. Investors weren't just fleeing crypto, they were reevaluating their exposure to every major asset class as the geopolitical landscape shifted under their feet. Then came the Worsh factor. The nomination of Kevin Worsh to lead the Federal Reserve signaled a major shift in monetary policy. Markets view Worsh as a hawk, leading to concerns about tighter financial conditions and reduced liquidity. For an asset class like Bitcoin, which thrives on liquidity, this news was a direct hit to its growth narrative. We are witnessing a systematic withdrawal of institutional capital. In 2026, the era of cheap money is officially over. Tighter credit and a stronger dollar mean that riskier assets lose their primary fuel. Bitcoin spot ETFs, previously the engine of demand, have seen net outflows of nearly $1 billion in a single day. The liquidity is simply drying up. Let's look at the technical truth. The breakdown was visible days before the crash. The appearance of a death cross on the daily chart was a clear signal for institutional algorithms to begin their massive sell programs. This pattern, where short-term momentum breaks below the long-term trend, hasn't been this pronounced since the 2022 bear market. Market structure played a crucial role. The system was loaded with excessive leverage. When Bitcoin broke the $80,000 level, it didn't just drop, it cascaded. Nearly $2.5 billion in leveraged long positions were wiped out in 24 hours. Exchanges were forced to sell assets into a declining market, creating a domino effect that accelerated the price drop to the mid-70s. Algorithmic bots took over the narrative. These automated systems are programmed to exit at light speed when key support levels fail. Their rapid-fire execution created stair-step declines that humans simply couldn't react to in time. In a market where minutes matter, these bots amplify every downward move, turning a correction into a full-scale collapse. On-chain data reveals a deeper truth. We've seen significant distribution from long-term holders, the whales. These are the people who have held through multiple cycles, and even they are starting to distribute their holdings at a rate of 12,000 BTC per day. This suggests that even the most loyal diamond hands are hedging their bets against a longer winter. As we look at the support zones, the $75,000 level is the current battlefield. If this area fails to hold, the charts suggest a move toward the low 60s. This is a critical technical juncture. Every bounce is being met with heavy selling, suggesting that the buy the dip crowd is being overwhelmed by institutional distribution and panic. Sentiment has hit rock bottom. The fear and greed index has plummeted to 23, extreme fear. In the past, this has been a sign of a market bottom, but in 2026, the macroeconomic environment is fundamentally different. This level of fear is unprecedented in the post-ETF era, signaling a sharp deterioration in short-term investor confidence across the board. If Bitcoin was bleeding, altcoins were in a state of absolute collapse. Ethereum and Solana saw double-digit losses as investors liquidated their entire portfolios to preserve whatever capital they had left. The total cryptocurrency market capitalization evaporated by $111 billion in a single day. This bloodbath has left no sector of the crypto world untouched. This crash has reignited the eternal debate. Is Bitcoin really digital gold, or is it just another high-risk tech asset? In this stress test, the safe haven narrative was severely challenged. When geopolitical risks rose, investors didn't flock to Bitcoin. They flocked to cash and the dollar. This suggests that Bitcoin's path to becoming a global reserve asset is still long. Many institutions that entered the market in 2025 at the $100,000 peak are now sitting on massive unrealized losses. Their willingness to hold through the dip is being tested like never before. The previous consensus of continuous institutional demand has been shattered, replaced by a cautious, wait-and-see approach that is drying up the buy-side liquidity. The collapse has caught the eye of global regulators. We are already seeing a new wave of scrutiny on exchange liquidity and the safety of spot ETFs. The rules of engagement for digital assets are being rewritten in real time as authorities look to prevent similar systemic shocks in the future. This regulatory overhang will likely cap any immediate recovery efforts. Technically, the RSI is in territory not seen since the 2022 bear market. This extreme oversold condition suggests that we might see a relief rally in the short term, but with the current macroeconomic headwinds, any bounce could be met with even more selling. The oversold signal is a reflection of the speed and intensity of the collapse, not necessarily a guarantee of a bottom. Miners are feeling the squeeze. With the price drop, many are nearing their break-even point, where mining is no longer profitable. If they begin to sell their Bitcoin reserves to cover operational costs, we could see a final capitulation phase that tests the true market bottom. This miner selling pressure is a critical factor to watch in the coming weeks. How does this compare to previous cycles? In 2021 and 2024, we saw similar mid-cycle corrections, but never with this level of institutional participation and macroeconomic complexity. In 2026, Bitcoin is more integrated into the global financial system, which means it is also more exposed to systemic risks and global liquidity shifts. This is a new beast entirely. What are the recovery scenarios? A spring rebound is possible if the Federal Reserve stabilizes its tone and geopolitical risks subside. Bitcoin has a history of strong Februaries with average returns of over 14%. However, the market needs a clear catalyst to turn the tide. Without a significant shift in the macro narrative, we could be in for a period of consolidation. Despite the current price action, the underlying technology of blockchain and decentralized finance continues to evolve. The stress test of February 2026 is revealing the vulnerabilities that need to be addressed for the next wave of innovation. For those with a long-term vision, this collapse is a necessary clearing of the decks, paving the way for a more resilient ecosystem. In this new era, risk management is your most important tool. The events of this week have proven that the infinite growth assumption is dangerous. Investors must focus on reducing leverage, increasing cash reserves, and monitoring the macroeconomic landscape more closely than ever. This is a moment of reflection and recalibration for every portfolio. The contagion didn't stop with crypto. We saw a systemic sell-off in tech stocks and traditional finance. This was a wider reassessment of risk, and crypto was simply the canary in the coal mine. Understanding the interconnectedness of these markets is key to navigating the rest of 2026. Nothing exists in a vacuum anymore. In summary, the technicals are screaming extreme. The RSI is oversold, the volume is massive on the sell side, and we are sitting on a critical support level. The next move will define the trend for the next quarter. If $75,000 holds, we may see a slow recovery. If not, the truth of this collapse might be even deeper than we currently imagine. As we conclude this 12-minute investigative report, one thing is certain. The events of February 2026 will be remembered as a turning point for digital assets. The stress test has revealed the vulnerabilities and the strengths of our new financial system. For those who believe in the underlying technology, this is not the end. It's a necessary clearing of the decks. The path to a decentralized future is never a straight line. It's filled with volatility, disruption, and massive shifts in power. But through it all, the innovation continues. Stay informed, stay resilient, and always look beyond the noise. The truth is in the data, and the future is yours to shape. Thank you for staying with us for this 12-minute deep dive. We'll be here to track every move as the market evolves. Stay safe out there, and remember, manage your risk, because in crypto, the only constant is change. Let's look beyond the charts. Bitcoin's role in a multipolar world is only just beginning to be understood. As global tensions rise and monetary policies shift, the decentralized nature of blockchain becomes even more relevant. We are seeing a fundamental shift in how value is perceived and moved across borders. The truth of this collapse is that it was a necessary growing pain for a maturing asset class. The next decade will be defined by how we integrate these lessons. The future of finance is being written today, and you are a part of it. Keep pushing, keep learning, and keep building. The roadmap is clear. Stay focused. Thank you for your time. This has been an investigative report by Business Growth.